Hello, everyone, and thank you for attending today's webinar, Reflecting on 2022 and Looking Ahead to 2023. Before we begin, a few procedural points. At the end of the session, we'll hold a Q&A as time permits. You can ask questions through the Q&A function on the right of your screen. Your questions will only be visible to you and to our industrious Flexport team. We will also share a copy of the slide deck at the end of the presentation. All right, moving on, it's time to make the lawyers happy. Please keep in mind that all information provided in this session is based on the situation at this current time and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. All right, now our identities revealed. I'm Phil Levy, I'm Chief Economist at Flexport, and I'm very excited to have with me our founder and co-chief executive, Ryan Petersen. Ryan, good morning.
Good morning, everybody. Thanks for joining us.
All right. Our agenda today is pretty simple. 2022 is drawing to a close. 2023 is rapidly approaching. We're going to try to identify the big themes we draw from the past year and the major things that we're watching for in the one to come. I'll take macroeconomic stuff. Ryan's going to take logistics. I'm a trade person, I know a comparative advantage. So just to make things interesting, we're going to try to limit ourselves to 3 themes each per year, although sometimes you can tuck up a whole bunch of things in a theme. But that's going to leave some important developments on the cutting room floor. Your opportunity to nudge us towards those is to put things in Q&A. Before we start, as is our wont, we want to hear what you're thinking. So we're going to start with our first poll question. All right. And you've got the poll button there on the right. So here's the question. When you think of 2022 in logistics, you think, one possibility, all's well that ends well, I like lower shipping prices. Second possibility, with wild fluctuations, it's now very difficult to plan. Third possibility, I feel confident that pandemic era craziness is behind us. Fourth possibility, my worries just changed from shipping costs to high inventory. Or fifth possibility and final, I'm glad I'm not someone who ships, but I'm eager to hear what's been going on. So obviously there could be some overlap. You could believe more than one of these, but we will ask you to sort of register your opinion and we will see what everybody says. We'll give it a minute or two. Thank you to those of you who have already voted.
I've never used this before. The polls are over on the right side of the screen there.
Yeah, that's right. There's a little thing right above the Q&A button. Click, no wrong answers. We might mock some of the answers, but or strenuously disagree. We won't mock. All right, it looks like we have a solid front runner. Well, actually, it's shifting a little bit as those of you get maybe the gradual, thoughtful ones are adding their voices. But I think I guess you select for this when you come and hear a webinar on what's going to happen next. But the leader at the moment with the plurality seems to be, with wild fluctuations, is now very difficult to plan. That's a fairly reasonable response. Ryan, where would you have been on this?
I would have thought people like the low shipping prices more than after all the complaints over the last couple of years.
You just find the next thing to worry about. It's I think that's always something response.
Human nature.
Yeah, exactly. So, all right, that's great. Now we actually do have, now an interesting note, because we're going to come back to this a little later in the webinar. Coming up in second place is my worries just changed from shipping costs to high inventory. Actually, our next poll, which is going to be a little while after we discuss 2022, our next poll is going to ask you to maybe say a bit more about what those high inventory concerns, and we'll talk a bit about how that factors into where we go next. All right, great. Thank you all for participating. It's great to get your take on this. Let's jump right in. And so, as I said, each of us is going to look back at 2022 and try to identify what were the big sort of driving factors. And I will start us off, since we try to go from the broad to the more specific, and I get macroeconomics. So I'm going to pick as my first one that part of the story of 2022 was that goods consumption eased back to a steady but elevated level. And the next slide will show a bit what I mean by this. That if this is a slide that goes back beyond 2022, it actually takes us to a year before the pandemic. The vertical gray bar there is the recession that accompanied the onset of the pandemic. And what you see is things have been pretty stable. I should say what this is. These are the various components of personal consumption expenditures in the United States. So prior to the pandemic, they kind of moved together. We got this all normalized so that they're all at the same on the eve of the pandemic in February of 2020. Then what you see is you see the shock. You see services, which ends up being the lowest of these lines, but is the biggest, in fact, in terms of component of personal consumption expenditures, is about 2/3. It does a big drop and then it gradually rebounds. I would argue that the key story where we saw all the pressure, where this came from, was the behavior of these other two lines, the green one and the blue one. That represents, the green is non-durable goods, and the blue is durable goods, durable being those that last for 3 years or more. And what we saw was that they recovered very quickly to their pre-pandemic levels after that initial drop, and then they kept going and going and going. And the reason we do this normalization is you can read off this chart that you ended up by the spring of 21 with durable goods consumption something like over 35% above where it was pre-pandemic. So my claim for the story of what we've seen in 2022 was we backed off from that. And we held, it's not exactly level, you're still getting a lot of fluctuations, but they're small relative to the fluctuations we'd had in a couple of years before. I'm looking at durable goods in particular. Non-durables are even smoother. They ease off, but look where they're easing off to. They're not easing off to 100, so it's back where it started, or even, maybe 105 might have been normal growth path, given that consumption sort of grows a bit over time, and over a couple of years, that's where you'd expect it to be as the economy is growing. No, they eased off to fairly elevated levels. So durables were still up 25% over where we were pre-pandemic. That's a lot of growth over 2 years, even if we hadn't had it before. And when we've sort of forecast this forward, we're just about to come out this week with a new Flexport consumption forecast, which predicts the 4 months to come. But so far, what we've released so far, you haven't really seen a big drop off. These things have kind of stabilized, and stabilized where where services has gotten back to where we were. They have stayed at a high level. So I think the story is twofold. One, we didn't keep accelerating. It didn't get worse and worse and worse, but nor did it back off. And by the way, sometimes it's interesting to compare this to what would we have expected to see. And somewhat unusually, we had a lot of public expectations about what was going to happen on this. When you had the Fed early on saying transitory, 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 they were looking at things like this blue line. Because remember, durable goods, sofas, refrigerators, appliances, stuff that's going to last more than 3 years, how many of those do you really need? And so the theory was, okay, we got super low interest rates, people are stuck at home, they can't go out, you decide to get that new appliance now or the new TV. But once you've gotten it, you kind of pulled forward your consumption from future years. That was the theory. And so therefore that should ease up. It should drop off. We just haven't seen it yet. So to me, that's a big story from 2022, is that we didn't get that sort of big drop off. We didn't go back to pre-pandemic consumption patterns where these things were all in line. There was some let up, and that's important. And I think it'll get to be important perhaps for what Ryan's going to talk about, but it stayed at a pretty high level. So that's my number one.
A great graph also just showing, hey, services are back. So it should be all systems go right now, at least for the consumer. But that's sort of not the story that we've all heard and are telling ourselves that, recession is here. I mean, maybe I just hang around with naysayers and people who believe in the end of the world is coming, but everyone I know is certain that a recession is baked, but the consumer seems really strong based on this data.
Yeah, and I would say that as we look at the economy now, there's a bunch of puzzle pieces that don't fit together very easily. So maybe we're missing some pieces, and we'll come to a bunch of these. But you're right, there is a lot of concern about recession. We'll talk about what's driving this stuff, where it's going to get to. But I think yes, that is the point. Is that this, you can't look at this and say that it signals weakness. There's going to be a question of what's driving this, but but it doesn't look weak. So, all right, Ryan, you still with us?
Yeah.
Good. So let's go on to the next one. Let's give you your first shot.
Yeah. Well, hey, so from a logistics standpoint, the obvious main first thing that's happened is that transit times have really improved. We hit a state over the last couple of years that was frankly embarrassing for anybody who works in logistics. It was taking something like 120 days to get cargo from a warehouse in Asia to one in the United States. And as a reminder for everybody, the ships only take about 2 weeks across the ocean. So a lot of delays, sort of lack of infrastructure. We can go. We've talked ad nauseum over the last couple of years about the causes of that, but those have dramatically improved to where ocean freight is becoming much more reliable. Still not back to pre-pandemic levels. In fact, I think we have the graph on the next level, which is Flexport's proprietary index that we built on this, called the Ocean Timeliness Indicator. For all you out there who want to track this with us in real time, we update it, I think every single week. If you go to flexport.com/research, you'll see all of our various economic indicators that Phil and his team have created, and that we constantly update. And so you can see that spike where transit times hit 120 days, sort of 110. It seems like the real plateau there at the top. Come way back down. We're not back to where we were, but the trend sure looks good. And what we're seeing, in qualitative aspects at the ports, they're running much more smoothly. A lot of these delays are sort of to do with the financial health of different companies and their ability to get goods moving and pay for things on time. So there's some economic impacts that's flowing through to transit times. But overall, I think you can count on ocean freight again. And that was a big question for the world, frankly, is are we going to, if ocean freight remains at 120 days, and by the way, you couldn't even count on 120 days. It looked like it was always going up. So you didn't know what it was going to be. And if it's that variable, it's very hard for you to run a global supply chain. And people started to talk a lot about deglobalization. And this was a major question mark on the whole regime that we've been living under for the last 50 years. And certainly since the invention of the ocean container, that's made it super easy and cheap to ship anything anywhere in the world. That was under risk. I think we can all breathe a sigh of relief, frankly, from where I sit, that we need to be able to service our customers at Flexport, but the world needs to rely on cheap and reliable shipping to have a functioning economy.
So, Ryan, when you look at this,
it'll flow into a couple other stories here, like inflation, like the price of shipping. We'll talk about those over time here.
Yeah, no, I'm actually going to get to inflation in just a minute. You're giving a preview, but let me ask you about this for a second. How do you explain the improvement? I've suggested that it was maybe more than a little bit of a let up in demand. You were involved in a lot of discussions about what people should do better. Did we learn lessons? Did we expand capacity, or did we just we're no longer under the same strains?
We're no longer under the same strains. I'm not convinced that we've made any strides to improvement in terms of the underlying infrastructure and the capacity to move cargo. I haven't seen anything material that would lead us to believe that, hey, the next time we get 20% more containers imported into the west coast of the United States, we'll be able to handle it and the ships won't back up. No, I think the ships will back up, and it may get worse depending on how the current negotiations with the union works out. Whether we ever have more automation or not to make things run faster. So no, I'm not convinced that we got any improvement on the supply side or the capacity of our infrastructure. We just thought the volume of container shipping went way down, and so that the industry could keep up with the existing infrastructure.
Okay, no, that's an interesting take. All right, let's go on. And Ryan's already mentioned, but my next one, hardly a secret. Inflation surged. It may feel like that's actually been with us a really long time. Was that a story of 2022? Well, a lot of it was. In the next slide, I'll show some statistics on this. That this is both a U.S. and by the way, I don't have today's CPI number in here, but I'll talk about it a little bit. This is you see both what's happened in U.S. and Europe. And you see, yeah, it did actually start in 2021, but it kept roaring.
A couple of the dotted. What is the TM?
Yep, I'll get to all of them. So there's a big question in all of this, which is, yeah, inflation. what exactly do you mean by inflation, which is essentially what Ryan is asking me. And there's a bunch of different ways you can measure it, and the different ways you measure it are not all giving the same story. So let's talk through this a little bit. The top line is domestic, the U.S. measure of inflation, the CPI, I believe.
Black one.
Yeah. So the solid black, that's the headline. That's the headline where today it was just at 7.1, which looks like a further backing off. The solid red line is the headline for Europe, what they were having with their inflation measure. Now, why do I then sort of clutter things up with dotted lines below? Remember that when we talk about inflation, what we're talking about is take a bundle of goods and look over time at what happens to the price of that bundle of goods. The trick to this is you don't always get the same answer for any bundle of goods. If you do a different bundle, you might get very different answers. So what you'll often hear talked about are the headline inflation numbers. That was today's 7.1, and then a core number, which tends to be smaller, which excludes food and energy. It's not always smaller. What tends to happen is that food and energy prices are a lot more volatile. This year, that had a lot to do with the conflict in Ukraine. But in general, if you look over the longer span, you often see the headline number fluctuating around these core numbers. All right, what does this tell us, and what's important from looking at these in this graph? Well, if you look at the headline numbers, and let's focus on the U.S. for a second, the headline numbers got way up there, and then they backed off. And this morning's news was it continues to back off. The core numbers and the trimmed mean, PCE is sort of a really core number. It trims off a lot of the volatile elements. It tends to be a thing that the Fed looks at a lot. What you'll see, that trim mean number has not backed off. That it has actually stayed pretty elevated throughout. So when you ask, hey, is inflation starting to recede? Is it over? There's a big, which the Fed is asking, there's a big question, which is which measure do you want to look at? I would suggest that the measures that you ought to be looking at are the dotted line measures there. Things like trim mean PCE or core personal consumption expenditure index. These are the price deflators that went with those numbers I showed earlier. That's what the Fed has looked at. They think that's the better long-term predictor of inflation. Note some of the big differences in behavior, though. That number was slower to start up. If you compare the dotted black line to the solid black line, it didn't really start until much later into 21. You'll note that the Fed was late in terms of actually reacting to these. I'll talk about that more in a minute. And whereas the solid line has peaked, the other one hasn't. The last point that I will, and nothing has peaked for Europe. The last point that I will make on this is that, especially as we interpret things like today's inflation numbers, it's worth listening to what the Fed and Chairman Powell have told us about all of this, which is their goal is not inflation stability, it's price stability. What's the difference? Inflation stability is what you seem to have there in the solid black line, where it's kind of gone up and then peaked and then flattened out. There, inflation's not changing very much. Price stability is when that dotted line is at 2%, and it's not. It's closer to 5%, and that's their goal, is to get back to where it's not whether inflation goes up or down, it's whether prices go up or down, and they want prices going up by about 2% a year. So to me, and we'll talk about some of this.
Inflation stability, but at 2% annually instead of 7%.
Well, right. So it will go with it. If you're at 2% annual, then the inflation is also stable. But it's just, you can have stability and not have a happy Fed in inflation. But they have a legislative mandate. It's full employment and price stability, and a steady 7% inflation does not count as price stability under their definition. So that's a big story. We've seen, so 22, we saw this continue be a big deal, especially by some of these other measures. I'll give a little bit of evidence later after I give Ryan a couple turns on how the nature of inflation has been changing if we look at some of the subcomponents, but changing in a way that's actually kind of worrisome to the Fed, where it looks not as extreme, but also not as transitory as it once did. All right, Ryan, over to you. Let's see what we've got for logistics.
Well, the next big trend or big headline, I think, and they're related. Maybe, in fact, you could have put this one first, is that the volumes have dramatically declined. That we're seeing record numbers in December of blank sailings from carriers because there's simply not enough volume to justify deploying all their ships. Blank sailing is when you take a ship out of the rotation. The container volumes are just down quite significantly. In fact, if we go to our next slide, you'll see that. Now, we're not seeing this in the consumption data, so this is where the big question marks come up to about what's happening with inventory levels, because if volumes of imports are declining, which we see here in this black line.
For some categories, yeah.
Yeah, in some categories, thank you. That we see, if we see declines in container volumes entering the country, then, but sales are still high, well, then something's going on, right, with the inventory levels to balance those two. And so that's, from the logistics standpoint, this is a big part of what's explained faster transit times, the ability to get space. It's no longer an auction to get your container onto a ship. You could pretty much find capacity, although the carriers, they're feeling a lot of pain right now, and should expect that to increase next year as prices get renegotiated in contract season. But these ocean carriers, very painful to see this steep decline in volume at the same time that prices are coming way down. I don't think many people are going to feel too bad for them after the last couple of years of record profitability. But the reality is, we live in we live in the present and not the past, and that no one wants to lose money. And I think it's going to be very difficult to make money as an asset owner, and that starts to explain a little bit why the container shipping lines are not an attractive business for Wall Street. There's only a couple of them that are public companies. Most of them are, and even those are basically family or government held with a very small percentage float, because it takes a family or a government to be able to ride out these cycles. Turns out to be a great business if you can really take a long-term 30-year investment horizon. You'll have a couple of years that are magical, and perhaps decade or more ugly years. And it's only tends to be a family business or a government that can operate on that time horizon. Wall Street just doesn't love it. So that gets into my a little bit. I'm getting ahead of myself here a little bit, but this is a trend that we got to probably, not the way that we wanted transit times to improve. If you're in the industry, or if you're in the freight industry, or if you're running a business, you want there to be strong demand and that continues to sustain imports. But if your transit times dramatically improve, as we saw, all of a sudden you should be flush with inventory in stock in your warehouses and not need to order so many more. So we've just seen this decline in orders, pretty much secular across the industry.
Yeah, one thing I'd add in on this, to put on my geeky economist hat, if we think about sort of basic supply and demand, what's notable here is we're seeing moves in consumption levels, 20%, and then we're previewing some of the stuff you're going to get to, Ryan, on what's happened with prices, but dramatically bigger price moves and then shipping moves, which is what we would expect if we have, in the short run, fairly inelastic supply and demand, where sort of otherwise, a 20% or a 17% shift is not moderate. It's still a pretty big drop over a short time period. But then you see those effects magnified as they ripple through the system. All right, good. So we've had the drop off. Let me come back and we'll keep it moving with my last one for my 2022 headlines, which is related to what I was talking about before, which is, I'm going to say, central banks go to work on price stability. So that's one of the focus. Tomorrow we're going to hear what the Fed does. People are expecting a 50 basis point hike. That's reasonable to me. But let me put that in context. If you look at the next slide, that looking back at what we've had in 2022, I think it was March when the Fed started doing this. This is really trying to put it in context. The black line is the Fed funds rate. The red line is the ECB's equivalent. And we're going way back. We're going back about 15 years on this one, because that's about how far back we have to go to start seeing Fed funds rates of the sort that we're seeing now. It was on the eve of the global financial crisis. And I like this graph because it also just shows you how steep this is and how unusual, because even when we were sort of raising rates before the pandemic, it wasn't this steep. And this only covers part of monetary policy, by the way. We've got limited time, but we're not covering the sort of working off of the Fed's a balance sheet, which was substantial, got up to they went from about $4 trillion to $9 trillion during the pandemic and have just started turning that around. But what you see is they were near zero throughout most of the pandemic, and it was around March of this year, the Fed really started to take action. If we look at what was happening in Europe, they were at negative policy rates, even in nominal terms. And they have started to match action as well. So now the trick on this is there's how fast are you raising, and then are you at a high level? The how fast are you raising? Well, that's pretty obvious. You can see that right from the graph. This is how steep it is. Whether the level is high, the proper comparison is not, oh, we're back where we were in 2007. The proper comparison is, where are we relative to inflation? What's happening to real interest rates? And even by pretty conservative measures I showed in the earlier graph, like that trim mean PCE, that was closer to 5%. So at least if you make that comparison, in real terms, the Fed is still looking at negative real interest rates. And that's why there's a discussion, which is, wow, the Fed has done a lot. Isn't it time for them to turn around? Versus, we're not there yet. We don't even have, the Fed has just talked about a neutral rate as a real rate between 0 and 1%. We're not there. So this is the question. Very likely tomorrow that they keep going. Markets are betting on how long they keep going. But certainly I think you can say that we had, in prior years, fiscal policy played a big role. Some of the putting, checks in people's pockets, which did have the effect of driving some of that consumption spending. What we're seeing now is the game is monetary policy. And every number is scrutinized to see how is the Fed likely to interpret this. When are they going to pivot? When are they going to turn around? But this was a year of the Fed really trying to reverse course and tighten as rapidly as we've seen. I don't actually know when the last time they've tightened this rapidly was.
Yeah, and I think this is always a little bit abstract for my layman's brain when I see Fed rates. It's like, how do I translate this to something that means something? And like the easiest way to understand this is that last year, 40% of homes in America were refinanced because the interest was so low. People understood that this was a generational moment. You're borrowing at 2% while inflation is 8%. I went and got a mortgage on my house. I didn't even need it because it looked like free money to me. And that free money is in people's bank accounts, and that's a lot of what's contributing to both consumptions and services remaining high that we saw in your earlier graphs. So this is sort of the linkage between what feels like abstract Fed policy and like cash in people's bank account that fuels the real economy. And of course, a lot of it has nothing to do with consumers, but it's about companies borrowing. It's about investors. Where do they deploy their capital, et cetera. And there's probably a lag. Like it'll take a little while here with consumers no longer refinancing. There's going to be way less. There already are way less homes being refinanced now. But the cash is already in the bank account from last year's refinancings, and people are going out to buy the car, or upgrade the couch, or whatever else. There's durable goods purchases and others. Before too long, they are spending beyond their savings right now, beyond their income, and spending down the savings. You showed me that graph in the prep session. I don't know if you have it in the final here, but that.
I think we'll have that a little bit later. But you raised two great points, Ryan. One of this is it's always a good idea to sort of take this from the abstract and bring it home. So yes, things like mortgage refinancing, but not just mortgage refinancing, things like initial purchases. We've seen a housing market that's pretty much gone on hold as everybody says, wow, this is crazy. I'm not going to take out a 7% mortgage and be stuck with this, especially if you think that it's temporary. But that, of course, then has knock-on effects to, people buy a home, and then what do they do with the home? You put in appliances, you put in furniture, you put in all these other things. Well, if you're not doing it, then you should see a slowdown.
I call it the iron law of remodeling. No matter what countertop you bought, the house is in the house when you buy it. It's not the right countertop once you discuss it with your house.
Yes, well, that may have something to do with spouses and the like.
I think it's going to have a long-term, Phil. I think it's going to have a long-term impact on the labor market, because if people bought that house at that low interest rate and they know they're never get, maybe the mortgage is more valuable than the house. They got this incredible 2% mortgage. If they want to move, they're going to have to pay 5% or whatever they've gone to, 6%. They're just not going to move. And all of a sudden you have a stagnant labor pool where people can't just move to the nearest opportunity. Now, maybe remote work makes up for that, but I think that's going to be a really interesting trend over the next decade or two, is if this whole cohort of people that bought houses in the last year and refinanced their house in the last couple of years just are stuck in the home. Now, maybe, hopefully that's worth it for them financially, obviously, but a very interesting trend.
Yeah, no, I think you're right. I think that is a big deal. I think the way people have been acting, we're not delving into the housing market here, but it's a worthy question, is as if this is an interlude, that the Fed had to do this for a little bit to bite all this stuff, in the backside, stop it. But then that's okay because you can sell your home in a year and these rates will drop back down. There's no guarantee of that. And you're right that when people get sort of locked in, the cost of relocating, even if you're just going to do the exact same value house, but if you took your initial one at a 3% mortgage and now you're looking at a 7% mortgage, that becomes a really costly move. And that does affect how flexible is our economy, which is some of that is how much can people move from one sector to another, but often that means moving from one place to another. And so, no, that's an important point. The other thing that you had raised earlier, which I want to make sure that we do drive home with this, because it's a really good point, you talked about how this stuff doesn't kick in right away. And that's exactly right. And the Fed will talk about this, and it's part of what's making the Fed's job difficult, which is the sort of received wisdom passed down from Milton Friedman, I believe, is this policy kicks in with long and variable lags. So think of a couple of years, but they're not very precise on that. And that's what's hard in terms of the Fed's task right now, is that what they're doing tomorrow may be affecting, inflation in mid-2024. Obviously, you don't have data for mid-2024. You're having to guess at what those effects will be. You're having to look at models, but so far those models haven't been terribly accurate. So both very good points. And it also affects business. Actually, I'm also going to put a preview. It affects things like inventory because, what are carrying costs? What are things, how expensive is it to hold on to stuff if you have to, say, finance that, borrow something in advance and then pay it back later? When those rates go up, it matters as well. So as maybe some of our audience will tell us back. All right, let's turn it over to you, Ryan. We previewed some of the stuff on prices, but this is what we intended as the good news in our early poll. People were already moving past it. What's happened with freight prices?
Yeah, so and these are all intricately linked. That the decline in imports led to an improvement in transit time, and at the same time, a supply and demand imbalance is now favoring the shipper, now favoring the importer exporter rather than the carriers in this world. Prices for ocean freight have come down dramatically. I think we all knew this would happen. I at least was not predicting when it would happen, but you sort of knew it was inevitable that you couldn't sustain the prices of the last 2 years for where the price to ship a container went just absolutely through the roof, back to almost pre-pandemic levels in the spot market. Contracts are still signed, and most people are, the contracts are being honored for last year, but the spot market has come way, way down. I think we have the graph on the next one to give you kind of a sense of this. And again, this is a simple thing of supply and demand. Once the container ship is full, the marginal price, the cost of that next container going on, it goes to whoever's willing to pay the most in a classical economic framework. And it's probably not you. And if it is, you better have a really good business that has margins like, the best companies in the world. And so a lot of companies, their businesses were non-economic at that model of 12,000. We saw some peak at 20,000, not on average, so it didn't make it into this, but you saw peaks of 20,000. By the way, part of what happened was the only way to get on a ship was to pay for the super premium service, which is the super premium services are either a faster ship or you're the last container onto the ship and the first one off. They're actually wonderful services. They can save, in a normal environment, save 20, 30% of transit time, a premium ocean freight service. But during the peak of this, it was the only thing that, if you were going to get on the ship at all, you had to buy the premium. And the premium service was adding a few $1,000s to the cost on its own. So those are normalizing. You can see it come way, way down. I don't have a prediction for next year, but I wouldn't predict that we go back to the world that we were in, unless suddenly you have this huge increase in container volumes, which we're not seeing yet. But that's going to be the big open question, I think, for 2023 that we'll get to in a moment, is what happens with that supply and demand imbalance? What are the factors there that make shipping either affordable or go back to where it was?
Yeah, we actually have a couple. Maybe we'll go to the next slide, which is, I think, another version of the rates. By the way, Ryan, which rate do you look at as sort of a reference rate? There's obviously multiple ones, whether you're talking about Trans-Pacific, Transatlantic, Far East,
Yeah,
Westbound.
I
What do you
mostly look at Trans-Pacific, eastbound into the United States, West Coast. I probably that's my personal bias because I live in San Francisco, and one and two is Flexport's, something like 50% of our total volume as a company is on that. That's the world's biggest trade lane, and we're overweight on it.
Yeah, yeah. All right.
Flexport's now the third largest American company on that trade lane, the world's largest. So we're growing pretty fast.
Good thing. Good thing. All right. And one of the things, if we move forward a little bit in these slides, this has had an impact. And I sort of previewed this a little bit before, where remember I said that the components of inflation, that the parts of that bundle, there's goods that weigh in and there's services. If you look at personal consumption expenditures, what I had initially showed on my first point, I said services are about 2/3 of consumption, goods are about 1/3 of consumption. What you see here is that services are the red line, which started out on top, and then this is the same time frame I showed on that initial graph where it goes back about a year before the pandemic. And goods prices goods price inflation, was lower. Then we saw goods price inflation really spike. Then what we've seen is it started to come down. Now, sometimes we have discussions, and I put this right after Ryan's discussion of how freight prices. Is this freight prices or is this just sort of supply and demand? I'd probably opt a little bit more for supply and demand. That freight prices factor into things. And it depends on the good and how many of them you can fit in a container and the relative value and so forth. But an awful lot of what I think we were seeing before was that when you couldn't get the goods to restock the shelves, you either kept your prices high instead of putting on sales, or you raised prices. What we've seen more recently, if you look across the last year, those services prices have crept up. That services inflation, whereas the goods have shifted down. Remember, services is about twice as big as goods, so you can keep overall inflation pretty constant, but there's a bit of a rotation there. I said this was worrisome to the Fed. You see how much the goods jump around. Services don't seem to jump around that much. Some of this is things like housing, other stuff. And so once it gets there, it can be pretty lodged into place, and that means it's harder to get out. So this is just linking the fact that it's cheaper to ship goods, goods are more abundant. We are seeing that in the price numbers, but it doesn't mean necessarily that inflation overall is behind.
Yeah, it'd be really interesting to try to design like some experiment, an economics experiment. How could we unpack what percent of inflation in goods came from the price of shipping going up versus the scarcity? I don't know. Maybe it's impossible conundrum to figure out to unpack the complexity of all these things. But
oh no, it's absolutely doable. Just give me the head count. We'll talk after the webinar.
Okay, Phil.
All right, just kidding. All right, let's move on. So what we want to do next is another poll, and we've already talked a bit about how there's a puzzle here, which is that we're not alone in fixating on what's happening with inventories. As Ryan said, you're seeing consumption stay kind of high. Imports are dropping, at least in some categories. You all told us in the first poll you were worried about inventories. So, and you can see data. We're not presenting it here, but there's data about full warehouses and inventory to sales ratios that are climbing back up. So what does all this mean? Is this a classic bullwhip effect? Is this a return to pre-COVID norms, or is it something else? So we're not going to ask you to opine on what's going on at the national level, but if you're in a business that does these sort of things, as many of our attendees are, then for your business, do you consider your inventory level A, something you don't worry about, it's right where you want it to be, B, too high, but that's deliberate, you're just hoping that sales keep up, you're optimistic, you plan for it, so the inventories are high, C, higher than you want, sales have already disappointed, D, lower than you want, you're actually still catching up from the pandemic crunch, or we keep this option here just so that everyone can participate. Irrelevant, you're not a business with inventory. All right, well, we have some of you who are attending this to learn, which is absolutely fine. We like that a great deal. But a majority are, it's higher than you want, sales have already disappointed. Ryan, I think this is what you would have guessed going into this, isn't it?
Yep, exactly.
that we've got, so 52% of that, about 16% is deliberate, optimistic about sales keeping up. Clearly lagging is, lower than we want, still catching up from it. So we are seeing things like inventory to sales rise back up. Although it's interesting, depending on how you measure, sometimes rising back up to where it was pre-pandemic levels. So, all right, thank you for that. That's very interesting. We're always interested to see what you all are facing on the front lines as you handle this. Certainly a challenging time with that. All right, let's move on. We got a new year coming, 2023 in prospect. So what should one watch, and what comes next? All right, let me jump in. Same pattern with maybe a little bit of additional brevity so we can get to a question or two. Unveiling, first thing to watch, macro 2023, demand drivers. So this is one of those things where I cheat a little bit because we talked about what was driving things before, and I gave a bunch of options, whether it was fiscal, monetary, and so forth. There's really three things where consumption demand can be coming for. It can be sort of what's happening with wages, earnings. That can be how you do in the stock market. That's one category. It can be money that the government pumps in through things like big fiscal measures, as we saw during the pandemic, or it can be Fed policy, which is stimulating. If we look at the next slide, we'll see how some of those relate, but have pretty much gone quiet. So this is, in real terms, what's happened to U.S. personal income. This is picking up right about with the onset of the pandemic. And what you see is the top line, the blue line, is real personal income. And one of the reasons why we had this whole consumption boom and logistics crisis is the norm would have been that as we went into a crisis, that you would have had a sharp fall in income. There was no fall. We went up and we stayed up. So shouldn't perhaps be too surprised that consumption also went up. And in fact, some of the spikes in consumption look a lot like the spikes here. It's not too hard in this graph to tell where the spikes are coming from. If you look down below, the green line is real government transfers. So that seems to run kind of parallel to this, that when that spiked, income spiked. So that was what was driving things. If you look at the story for 2022, you can see that kind of went quiet. Everything flatlined a bit. Now, note, the government transfers are not all of what happens to real personal income. And so this is why, as I said, there's other components, and it's something to watch. If you started getting people with big wage increases, that would factor into this. We're seeing a number of sort of labor discussions where people are trying to work out what comes next. Some of that has to do with what people expect with inflation. But these drivers, we're not seeing, it looks pretty flat. And I think going into 2023, you don't see an awful lot of action there. Now, there is one part of this, though, where I think you do see some action that's worth paying attention to, which is the very bottom line there is real personal savings. And if you look and I'm not doing it here on this graph, but you'll have to take my word for it. If you compare the trajectory of savings that people had been on and then what happened during the pandemic, there was a big bulk of savings that people built up. Those savings rates went up, and it meant that they had this reserve, by some estimates over $2 trillion worth of extra savings. People argue about what's happened to that. Certainly some of it was spent off, but how much? But there's an argument that, I don't know, maybe 1.6 trillion is still around. It's not evenly distributed across income groups. It's tilted more to like the top 60%, but that gives buying power. That's the other thing, of course, you can use to finance things, is if you have savings
Bill,
that you can.
Is this a rate of savings, or is that a pool? Is that the
No,
amount
this is level. This is level. This is actually the amount of additional savings.
Definitely coming down.
Yeah, so it did dramatically come down. And so there's a chance there. This is one reason why I think we haven't seen a fall off in consumption that we might otherwise have expected with all the rising rates. But really, if you look at the two driving forces for 23, what to watch, there's what's happened to the savings, and so how much money do people have in their pocket from that. And then the other thing is what we've already been talking about a fair bit, which is what does the Fed do for all the reasons we talked about? How expensive is it to buy a home? How, if you need to finance purchase of a car, how expensive is that? That's why there's such a fixation on what the Fed is doing right now, because if you're looking at what drives demand, those are the places you're looking.
Bill, let me ask that question another way. That if that savings dollars there is above zero, that means people are they're spending less than they make. Is that fair to say, or is this the
Yeah.
dollar amount that's in their bank account
Yep.
and it's coming
Yeah.
down?
So what I've done here is there's three series. It's if you're a geek and you like to look at it, you can look at what the Bureau of Economic Analysis puts out on personal income and outlays, and they do a whole breakdown. Ryan, you and I were joking about accounting earlier. This is good old-fashioned accounting where all the columns add up.
Okay.
I haven't shown all of the columns on here, but yeah, this is what's left after everything else.
Okay.
So, but demand drivers, something to watch. All right, Ryan, tag you're it. Next slide.
Yeah.
What do you got?
Well, hey, the big one here is that the IMO. This is the group. I think the way to call it is a division of the United Nations, that the International Maritime Organization. So they're the body, the governance body for global ocean freight shipping, International Maritime Organization. And they have a new regulation that kicks in on January 1st, so about 2 weeks from now, that ships will have to reduce their carbon emissions quite significantly, and especially this will impact older ships. And the only way really for an internal combustion engine to reduce its carbon emissions is to go slower. And so now many of the ships are already going somewhat slower in order to reduce capacity in the network and control a transit time, ultimately to control price. So we're estimating that although the regs say they have to go 30% lower, actually the regs don't say this, but the physics says they would have to go 30% slower in order to achieve a 13% reduction in carbon emissions. In fact, many of them are already going slower. So we have estimated that this is going to have a 4 to 6% reduction in capacity for the world's ocean freight networks. If we're at peak demand, we can see that a 4% decrease in supply will send the price to the moon, as we saw the last couple of years. Currently, we're not at peak demand. There's a lot of blank sailings, a lot of empty, a lot of excess capacity on your average ship sailing right now. So I'm not predicting that this will have a huge impact, but it is on the horizon and something that we're watching very closely. I think the fact that we've already seen a reversion to the means in terms of price and transit time tells me that this is not going to be the biggest story of the year. Whereas if the prices had remained high like they were last year and this kicked in, I think this could have just a huge spike to costs. So something that we're watching very, very closely. I'm personally amused is the wrong word. I'm maybe it's even horrified / amused, whatever. If you marry those two words together about this regulation, because it's not actually going to reduce the amount of carbon per container shipped because you're shipping fewer containers. So you're not on a per container basis, the amount of carbon emitted is actually going up with this regulation. So it's sort of this like very silly. It reminds me of the time that the EU made you have to acknowledge cookies on every single website. Like, it seems like a good policy, but the impact wasn't really thought through. Didn't have the impact they wanted to. So.
And as you touched on the EU, I'll actually toss in something gratis on your environmental thing, which is there's other environmental things to watch in these regulations. Things like Europe was just moving forward. There were stories this morning that I haven't fully processed on their carbon border adjustment mechanism. So I agree.
Similar to VAT, right?
What's that?
Is it something around similar to a VAT type of a tax where?
Yeah, it's trying to make up for the fact that the underlying premise is that it's unfair for European producers if they have to pay environmental costs, but imports don't. So they're essentially doing a tariff to offset that. They call it a carbon border adjustment mechanism. They had put it forward in theory, and I think what we've just had within the last 24 hours is this is advancing. So it actually supports your point of watch environmental regulations and how they intersect with logistics, because there's interesting stuff going on in that space. Our own Flexport.org does a lot of interesting work in that space as well. So I agree that it's a very interesting thing to watch in the year to come.
It's a tough moment for European economy to add another big tax and a double tax on, because you now have to find new sources for these things in a world that where inflation we just saw is already going through the roof in Europe, and they've just an ugly moment for the economy in Europe.
Yeah, it is difficult. And I'm going to come to that in a bit. I'll sort of play that in, but it's a good foreshadowing. All right, if we move on, because we do want to get to a question or two, I'm going to bring in sort of a bit of a curveball here and ask, because that's what you do is sort of the forward-looking one, where you can't put up data slides. Ask, is there a price to pay for uncoordinated international policy? What do I mean by that? I'm talking about things like trade policy, where you've seen some big disputes between big players. You have the Section 232 stuff on steel and aluminum, the U.S. tariffs that were imposed. You just this last week had the WTO say that this was illegitimate, and China has now decided to challenge the U.S. on national security things with semiconductors at the WTO. But the WTO is not functioning very well. They can render, because they don't have an appellate body. That's a whole different webinar. But you have a dispute with but it's not just the WTO. The electric vehicles, that you've had a very sharp dispute with Europe over this. In macro policy, there's not the coordination that there used to be. We're seeing one of the things I showed earlier, what was happening with the Fed increasing rates and Europe increasing rates. You saw the Fed was moving faster. Classic economic theory would tell you, then you're probably going to get a dollar appreciation. That is what we've had. It's backed off recently, but you're seeing some really big swings in exchange rates. And so these are the kind of things where in past decades, you'd be having Treasury secretaries and finance ministers and trade ministers all try to get together and do a coordinated response. Here, there doesn't seem to be a lot of this. The U.S. is not rushing towards trade agreements. And for decades, the gospel is if you don't do that, there's going to be costly consequences. You're going to have things like debt crises and retaliatory protectionism and investment restrictions. So for me, that's a thing to watch in 2023. Is there a bill to be paid for the fact that a lot of these things are going on in turbulent times and we're getting minimal coordination? All right, Ryan, let's see what we got for you as your number two.
Well, I think you got to touch on labor uncertainty. We've got, we still haven't got a contract signed with the ILWU, which is our West Coast Port Union. They're operating without a contract right now. Thank you, if you're in the ILWU, for continuing to unload containers, even though you don't have a long-term contract. The rail union, same deal. Congress actually had to intervene to stop the rail from going on strike. I think if a railroad strike at this moment would almost certainly cause a really severe recession in the United States. So that 40% of all the goods moved by rail, and if you don't have that, there's not enough trucks to make up for it. So you're just going to have less consumption, which is a hard recession. Not what we really want to end up with is Congress intervening. I don't know how the rail labor union gets things done if they can't go on strike on some level. You want to have some ability for that, but I also am very thankful for Congress stepping in. And then you've had strikes. I mean, I don't know that strikes in Europe are newsworthy events since they seem to happen all the time. But no comment there. But in general, I think this is going to be, a wild card, black swan potential that should be on people's radar.
Yeah, I think this is a good point. And I'll toss in a couple of hypotheses about what's going on, which is, it's when you're having negotiations between labor and management, it certainly helps if everybody agrees on how big is the pie and what are you splitting and, what measure are you using, even in terms of say, price level. And I think the fact that there's so much uncertainty, that you're seeing some companies that did very, very well over the last 2 years, but are facing very tough times going into the future, and we've seen some carriers in this position, it leads to where one side says the pie is huge and the other side says the pie is small. And then for all of them, it's, if you do a 5% pay increase, is that above or below inflation? Are you getting a raise or a pay cut? So I think it's a great point of a thing to watch. Not a total surprise that this is, coming up as an issue. All right, let's move on because we're getting towards time. And our next slide is me acknowledging, and I think Ryan foreshadowed this earlier, that one of the things to watch is unexpected shocks. That if, we did talk about this a year ago, but a year ago, we were certainly not talking about the conflict in Ukraine as a big driver of the global economy, and obviously it was. It had a disproportionate impact. I talked about the volatility of food and energy prices. That's true even in normal times. It was way more true this last year as these things got pushed up. You were facing energy crises in Europe. Ryan, I know you got very interested and involved in things like the movement of food, and that sort of moved food prices. So I think we just sort of have to acknowledge that's an ongoing shock. We don't know quite where that one goes. I think none of the outcomes look great. You could have it, sort of either, even if you get a resolution to the conflict in Ukraine, there's going to be a question of how you rebuild Ukraine, where there's plenty of troubles. And if you don't, it's not too hard to come up with more difficult scenarios. But I think it's just worth keeping in mind that, we have not escaped from geopolitics. So energy, war, and peace. That's my narrow category of things to watch for my last one. Ryan, what have you got?
Well, mine's sort of more mundane. It's what happens in shipping. Obviously, I live in the world of global shipping, logistics, and just where does supply and demand shake out? Huge unknowns. I'm very thankful for our asset-owning partners out there in the world that are willing to take the risk, because it's a really hard job to decide how many ships you should order. And it takes several years to make a new ship or an airplane, and you have no idea what the volume is going to be, the demand is going to be. If you go to this next slide, you'll see the difficulty that they have, that the world has got. This is order book. It's pretty firm. It may get delayed a little bit, but otherwise it's firm. The orders have been placed. That you're going to have a very big annualized growth, something like, it looks around 7-8% per year, high as 10 in some quarters. Net, I want to say the number is 25% increase in the container capacity, the capacity of the world's container fleet in the next 3 years. I don't think anyone is predicting a 25% increase in the volume of containers shipped. So that simple math tells you going to be open season. The rates should come down a lot, and it'll be difficult for carriers to make money. So for all those people who were hating on carriers the last couple of years, now hopefully you respond with some gratitude, because the next few years they're going to be having a difficult time to make money, and you may hate them or not, but I certainly am thankful that people are willing to lose money to keep the industry around, and that there are people who have family businesses and governments that have a longer term horizon than Wall Street to be able to make these bets and keep the fleet running, because we need it.
All right, that's definitely something good to watch and see how those reconcile. There is a supply response. It just takes time, and now we're getting the supply after the demand is backing off. We are near the end of our time. Let's close this up by giving the audience the last word. We're going to go to our final poll. You guys are going to get to say, here's what we're asking. As you look ahead to next year, those of you who are shipping, we even have an option for those who don't. Do you expect your shipping needs in 2023 to be lower than 2022, but still above pre-pandemic, back to pre-pandemic, dropping, things are rough, or above 2022 levels, we're growing? Or I don't ship, I just like listening to webinars to learn. So let's see where you all are as we wrap things up. We got a lot of people who are listening and learning. Thank you for joining us. Much appreciated. So it's interesting. The votes are coming in. We're getting a bit of a spread. But, Ryan, there's a bit of optimism here, right? This is, they're expecting shipping in 2023 to be above 22 levels. They're growing. There's still time for lower. It's actually a little bit behind. But are you surprised at the sort of spread of responses here?
Well, based on the consumer data that we saw, not really. The people are still buying stuff. So, that's good to hear that people are growing. We're not seeing the volume, so I think this is our hypothesis, is that the transit times improved, so that inventory got brought faster to the United States. You have more in stock. You can take a pause on orders, but that the orders will pick back up again once you sell through the inventory that's in stock. So it's always easy to make a narrative looking backwards. It's very hard to make a prediction going forward. That's been my experience. So I stick to the backward-looking narrative to make sure that I sound smart all the time.
That sounds wise. All right. Well, we'll conclude with this, and it's always fun when you can to end with a note of optimism, and so we got one there. This is the end of today's webinar. We're out of time, although not out of topics. Thank you, Ryan, very much for all of your insights. Thank you all out there for attending today's session. We will email out the slides and link to this recording tomorrow morning. There will also be a short feedback survey presented when you log off of this call. Please take a moment to share your thoughts and feedback with the team so we can continue to curate great content for you. Thank you all and have a good day.
Thanks, everybody. Happy holidays.